Glen Maguire, Chief Economist-Asia with ANZ, joins us live from Singapore via the Skype link. Glen, good morning. Thank you for joining us. Glen, the big headline from the US is that the bickering still continues. There is still no consensus between the Democrats and the Republicans. The Democrats are blaming the Republicans are blaming the Congress is blaming the Senate, and everyone seems to be blaming the White House.
Absolutely. I think, this is one of the key factors which differentiates this episode of discussions on the debt ceiling with what we saw last time. Last time we were able to move towards a resolution relatively quickly because we did have the Democrats and the Republicans already sitting down and talking about the various options. This time they seem further apart. And I think it's important to note that probably the most likely outcome is, to borrow that term we were using when we talked about the European central banks and the European crisis, is they'll agree to kick the can down the road. So what we'll see is the Republicans will agree to a temporary lifting of the debt ceiling as long as there is a meaningful discussion sometime down the road about the sustainability of US finances. And perhaps that's one of the key issues. Initially, the Republicans were aimed solely on defunding Obamacare. Now they seem to have broadened their remit to want a discussion on the overall sustainability of the US financial position, which does mean that an eventual agreement may be more difficult to reach.
Glen, hi, morning. What's been the call on emerging markets, in particular markets like Asia, or rather India, I should say, have been fairly sort of resilient to all the global news flow. In fact, for that matter, we've seen the markets only recover and touch new highs. Do you think in some sort of way emerging markets are, in the near term at least, decoupled from all the global news flow?
I think what we're seeing is, even though we do have this disagreement on the debt ceiling, most analysts are very strongly of the view that a US default would be a low probability event. There's two reasons for that. The first is that the actual flow of payments we have in the US, there's no significant coupon payments on the US debt through the end of October until we get into November. And also, given the damage it would do to the US reputation, it's very difficult to see either party actually allowing a default to emerge. So that risk event is seen as being rather low probability at this stage. At the same time, what we are seeing is perhaps a return to a situation which characterized the emerging markets more through 2010 and 2011. And that was there was a significant growth differential to the rest of the world. And also there was a significant interest rate differential. So I think that is re-attracting capital inflows back into Asia and into India, supporting asset markets in the region, and that's a positive. So we have policy uncertainty in the US, which I think is weighing on the US growth outlook, and once again making Asia, including India, look a little bit more attractive.
Glen, as of now, like you flagged off, markets are of the view that US government will not default and US economy will not fall off the cliff. What happens if there is no consensus before 17th of October and US economy or US falls off the debt ceiling?
Look, that would be an extreme tail risk event, and it would be one that would do significant damage to the global economy. It's not surprising that some of the most significant economic figures, be them at the World Bank or at the IMF, are warning about the grave dangers that would happen if there was a US default or a lack of consensus arising. And the key reason for that is the US yield curve is the key interest rate benchmark for the global economy. All debt instruments worldwide are priced off that. The US 10-year bond is the key interest rate in the global economy, with most debt and corporate borrowing priced off that. So if you did see a default, the price of US Treasury instruments would fall sharply, the rate or the interest rate on them would rise significantly, and there would be a massive rise in the global cost of capital. It would be a disastrous outcome for an economy that's still relatively weak and trying to gain momentum and exit decisively the global financial crisis. So there's enormous responsibility in the hands of the Republicans and the Democrats at this time. It's essential for the global economy they do reach an agreement.
Glen, really good chatting with you. Thanks, as always, for taking time out and joining us.